Hello, everyone. Today we are going to start up with a new thing, a new concept for the market. Yeah, we have got two, three viewers. Let us wait for others to join in and then begin our session with all the energy that we have got because it is quite an interesting concept that we are going to go through today. Also, we are going to look at on the live market what is going to be the United States CPI, that is the Consumer Price Index. So we will look into that particular data as well and how the dollar is performing. That we are going to see. Apart from that, we are also going to see today's overall market movement. Okay, and a very interesting concept. Yes, hello and welcome everyone. We have got seven people. So let us begin today's session as such. Here we are. Okay, this is something that I've done previously. So let's. So the USDX. This is the current scenario of dollar index right now. It has suffered a loss since 5 days now, continuous going down. But we have seen that this was a important level of resistance. This particular line, that is this trend line. It is an important level of resistance. The price could not break this resistance as such. The previous high was around 109.12. Now we have got a newer high, that is 110.76. So this is how dollar index has been from uh, March or April 2022. It has been in a constant uptrend, but now it is facing a retracement right now. Okay. So this is the current scenario of dollar index. Based on this dollar index, we are expected to, yes, hello, hi. Yes, we are expected to get, just let me change the settings a little bit. Okay. So here we are. We have seen a lot of data in this particular month as CPI data was being released from a lot of countries. Recently, we did a particular live streaming about the non-farm payroll or employment change. Later on, we spoke about the business cycle as well in the previous live stream. Now, the current scenario of the market has been since September of 9th, which is, I suppose, the previous week. After that, we have got GBP, very important data from GBP, that is GDP, that is gross domestic product, has come out, and it is fortunately in the positive scenario. Although it is lower than the market expectation of 0.3%, we are still in the positive territory. That is a good thing for GBP. And this particular thing, goods trade balance, is also somewhat positive. Okay, apart from that, nothing to be seen here. Now, today, as we are discussing and as we are here, everyone, we are going to witness the consumer price index for this particular month, the previous month, and the expectation is not so high, and people are actually, uh, the market is expecting a negative CPI, given the amount of Federal Reserve rate hike that has been continuing for a very, very long time. Yes, hello everyone. Yeah. So this is the current scenario of the market. The market is anticipating the just okay. So the market is anticipating the incoming data, and for that, the index is also red today, bearish today, because everyone is expecting the index to have fall down, the CPI to come down, and inflation is, if it is going down, then the dollar also will kind of depreciate in this particular cycle. But technically speaking, this is an important level which we are at and which we have broken down from this trend line that you can see, that is a 78.6% level for Fibonacci retracement, and then we are broken down from this particular level. The next level would be the parallel channel ka level, which is somewhere around 106 for tomorrow. Then it goes up, so somewhat we can retrace from this particular position. Okay, just give me a moment. We can retrace from this particular position till this point, or above this only, and we can retrace back up. Okay, again it might get some resistance at this position, it might consolidate and then pump up again. Nobody knows, because there is federal rate hike that is going to happen, which the market is anticipating, was previously anticipating to be 75 basis points. But right now I don't think that such a radical measure would be taken by the Federal Reserve if we see the CPI today to be under control. Okay, today's CPI, really sorry, today's CPI and tomorrow's PPI, both of these data are important from the perspective of dollar and dollar related pairs as such. Uh, Next, we are coming on to, yes, thank you very much. Okay, next we are coming on to our topic of discussion for today, which is the gap theory. The gap theory is quite an interesting concept from the perspective of technical analysis. And technical analysis, as such, has given space for a fundamental thing. Usually, gaps are formed due to fundamental factors. Usually, okay. And when the market is anticipating a lot of things, okay, when the market is anticipating other things other than what uh, the normal price action is. Okay, just give me a moment. Okay, now this is better. Just put it up. Let me share you the presentation today. Okay, so here we are. Where is this? Okay, so we are looking at the introduction to the gap theory. Gaps, as we all know, are certain area in the price action. Say, for example, here you can see this gap, okay, where there is no trading, okay, that happened. This is called a gap. Okay, gap in the price action. As such, there is a discontinuity in the price in this particular range, and this is called a gap. Okay, and these gaps are formed many a times in even the most liquid of the stocks, even in the most volatile of the stocks, or pairs, or whatever it is, right? So this is formed multiple times, and this is formed many a times, and mostly people believe that these gaps are formed based on some fundamental factors, which do not require technical analysis, or which do not require, you know, the understanding of gaps as such. Okay, these are normal, or these are abnormal phenomena in the market, and that is why people believe that this might not be the case, and we should not be aware of the gaps, we should not work with the gaps. And whenever gaps are formed, people are kind of scared. On the other hand, there are certain people, there are certain traders, there are certain analysts also, who believe that gaps are a very good trading opportunity. And if you analyze the gap very well, especially in a stock market, the stocks as well, so that can provide you the opportunity to work with gaps very easily, and it might give you the dividends that one is looking for, right? So, as we have already discussed, for our today's market discussion, We have done a little bit on dollar, where is it going, and then CPI data is inbound. So I'll be looking at the timing. The timing is somewhere around 6 o'clock when the CPI data will come out, and then we will analyze more upon that, and we will try to understand how it is going to impact the market till September 23rd, I suppose, when the 21 and 22, when the funds rate will be basically coming out for USD, right? So these are the factors that we are doing currently, and this we have discussed. This we are going to discuss in the future, in the very near future, and this particular thing, gap theory, and why is it relevant to our study of technical analysis? Many people understand this as somewhat of a taboo. Some people consider it as a very good trading opportunity, and some people don't even know how to trade when a gap is formed. Okay, so they just buy when there is a gap up and short where there is a gap down. Okay, so that is not the way we need to look at gaps. Then we will look at the common perceptions about gaps, obviously, why this particular thing is happening, common perceptions about gaps. Yeah, and how does the market interpret gaps? Okay, what does the market want to tell you, and why gaps are formed, and what does the market interpret through these gaps? What does the market want to tell you through these gaps? This we will understand in today's live session. Then we will get into the types of gaps and how to trade in them. The most important topic of today. Probably we will be able to cover this in today's session only, or else we will cover it any time in the future, as we are constantly learning every Tuesday on Market Insights, right? So we are doing all of these. Probably you all have had your evening tea, and everyone is in full energy, right? I suppose. So just bear with me. We will just do the introduction of the gap theory. Okay. So the gaps I've already told you. These are the range in the price action, okay, which has been not traded. Okay, these have not been traded in the market. Okay, this is the scenario where there is no trading within this particular price range. Okay, and that is why it is called a gap in the price action, a discontinuity in a very continuous form of price action, right? Price action usually we see through a line graph, right? If the candlestick is removed, then we see a continuous line as such. But when you convert it into the candlestick, which is a more accurate form of representing the price, then we can see such gaps being formed where there has never been trading. Okay, the trading has not happened in this particular range, and that is why it is called a gap. Okay, now gaps are formed usually in a drowsy, that means a sleepy market where there is no interest, or an exciting market. Okay, where people are buying and selling an excited state, or in a panic state, to cover their position, or to get that particular asset because they have some news in mind, or the market they are expecting something to happen in a particular stock. So this is where gaps are formed. These are usually formed in a continuous cycle. Okay, not in a continuous cycle, like in in those assets which are usually like these, like whether there is a interest, lack of interest, or there is more than required interest. Both of these situations may give rise to gaps. Okay, this is the particular position. And then there are certain conditions which traders look for to get a good opportunity to trade within these gaps, and after these gaps are being formed. Okay, so that is why when gap theory we understand in technical analysis, we usually look at gap theory not as a separate part. Okay, this is an interconnected whole. Okay, when we are studying technical analysis, the gap theory is considered to be a part of a whole. Understood? Whole as in not whole, HOLE, that is WHOLE. Okay, whole. So it is considered to be a part of the whole. And gap theory, when understood correctly, can give you a lot of information, a lot of guidance, okay, in how to trade and where to trade where such gaps are being formed. Okay. Now, common perception about gaps, what people understand through gaps, and what people want to know about gaps is quite different. Is quite different from what people, what the market expects it to be. Right? There's a difference between people's understanding and the market's expectation and the market understanding of gaps. Okay, that's a very big difference. So gaps can be highly relevant. Okay, they are very relevant, and that is why I'm teaching you today this. And it is usually formed in excited or panicked state, as I already told you, of the market. And usually, as we see many a times, you have seen in the uh, past, that there is a lot of assets, there is a lot of stocks where such state of the market has been, like the excited state of the that particular stock, or panic state. We have already seen that, right? There has been panic selling when it came to COVID-19 pandemic started. Then the Russia Ukraine war started. Then there was a panic selling of different stocks. Then there is also excited movement of the stocks. There is excited movement of certain asset class, that has been also being studied, and that is also witnessed in multiple situations, in multiple assets, in multiple markets as well. Apart from that, we need to consider this, that usually gaps are formed by fundamental factors, okay, not through technical factors. Okay, if I'm drawing some certain technical setup, or if I'm putting in some indicator on the chart, then the gaps cannot be understood properly. Gaps can only be understood through fundamental factors. Okay, there might be some company that is going come dividend and ex dividend. So once the company announces that particular dividend, then the price jumps up sometimes. Okay, and there is a gap up. Okay, and once the price, the dividend is provided to the people, to the shareholders, then the stock goes ex dividend and the price comes down to that level. Say for example, if today a stock is trading at $200 or 200 rupees, for example. So if it is trading at $200, and the company has announced a dividend of, say for example, $5 per share. Okay, so initially you see in the market, if this news has come out that there will be a dividend of $5 per share. Okay, so where does the company get these $5? It will take out the money from the stock's price only. So you will see that there is a jump in the price in the market. There is a gap up opening of that particular stock, and the price has jumped to 2,205 or 206, whatever it is, right? People are basically getting that stock to get those dividend, right? Multiple people are buying that stock at that level. Okay, so the fair value was at 200, the starting value was at $200. Okay, the price jumped at 205 after the news came out. Okay, and this is a fundamental factor, obviously, dividends, right? And then the when you see the price is being paid, the dividend is paid to the customers, to the shareholders, sorry, not customers, but to the shareholders of the company. then you see then you see that the price that was 2,205 has slowly inched down to its initial $200. Okay, that is how gaps are being formed in the market. Okay, there's this example. Okay, there are multiple examples in which gaps can be formed, and thus one needs to understand both the fundamental factors as well as the technical factors on how to trade, right? So gaps can also be very good technical tool or setup for trading. Obviously, I will show you throughout this particular live session how gaps can be understood and uh, you know paid with, right? And how we can earn in this particular setup. Now, another common perception about gaps is that gaps tells us the direction of the trade. Like I said, that people buy when they see a gap up in the market. They believe that the price, the stock has opened gap up. That means the price is going to go up, right? That is their perception about gaps. However, this is a error on their part. There is a error in their understanding of gaps, okay, which we need to avoid, which we need to avoid because we are following market insights. Obviously, I've seen. Okay, here it is. Just give me a moment. Yes. Okay. So people will look at the stock. If it has opened gap up in the market, then they will buy suddenly without looking at other factors. They believe that the gap, if there is a gap up opening, that means the market is bullish, and we must get this particular opportunity in the start itself. But that's where they are wrong. If the market is gap up, then there might be a state where the gap might be closed within that day or in the coming day. Okay, so that is a condition. That is a condition that I will teach you in the future slides. Okay, in the further slides as we go into. So we don't need to understand in this particular manner. Another way of perceiving gaps is that if the market has opened gap down, okay, if the stock was trading at $200 and the price opened suddenly at $195, okay, the price opened at $195. Previously, yesterday, it closed on $200. Okay. Now it is starting its trading on $195. So multiple people will say that the market is bearish today and we will short sell that particular stock. Or if I'm having that stock, then I will cover my position in that particular price range. But that is again an erroneous understanding of that particular situation of the market, right? So we need to avoid this error of understanding of gaps. Fortunately, because we are going to study today how gaps can be a valid technical setup, okay, and what are the correct and logical explanation, not just knowing about gap, that there is a gap here so we can trade in this particular range. We'll also understand how, what is the reason behind it, what is the logical explanation behind it, and where to and how to trade, right? Where to take a trade and where to avoid taking a trade, that is also very important. The other day I was meeting one of my friends, and we were discussing this opportunity, this particular thing, that most of the times we look for trading opportunity and stuff. But there is also one very very important reason that look forward we don't look forward to these particular understanding, that we don't have to look forward to every trading opportunity that comes our way. Okay, we need to also gatekeep that particular information, and we need to screen out all of that calls or all of that signals that the market is providing us, and only take those trades which we are short believing in that particular trade. Okay, so it is not just important how to take a trade, but how to avoid a trade is also a very good skill. Okay, that is a survival skill in the market. Okay, if you know how to avoid a trade, when to avoid a trade, okay, when to avoid trading in the market, then that is going to be a very very outstanding measure of a very smart trader and a very valid technical setup. Okay, just give me a moment, I will be back. So yeah, so this is the understanding of the market, that when you're trading, it is not just important to catch all the trading opportunities. Okay, it is also very important to avoid opportunities as well. And which opportunity to avoid, that is also a very skillful act of a trader, right? That is a skill, and that skill is developed through experience, through knowledge, and through learning. Okay, So a trader, just like a doctor, always has to learn. Look, these professions, doctors, teachers, and engineers, these are always learning, because there's something new every single day. They have to learn about that. And markets are the only thing that is changing every moment, right? And this is particular understanding of a trading analyst that we were discussing that day. So every day the market is changing, every day some new news is coming out, every day some different concept is coming out, every day people are developing their own indicators as well. Okay, I have also tried to develop my own indicators based on volatility, volume, trend line, stuff like that. So it is always about learning, it is always about the new things that are coming into the market, and how we interpret these particular information. So here we are. I guess there is no doubts from the previous session, so I will just continue. Okay, the time is almost up. There is 2 minutes remaining in the CPI data to come out. So I will just request my beautiful viewers to just keep an eye out for the CPI data. Just let me know what is the CPI data for today. Okay, so we can discuss uh, the information as such. Okay, just 2 minutes remaining. Let's see what is going to be. So the CPI today is going to be very, very important. Just to deflect from our point of gaps, we are going to get out from here, and we are going to look at the CPI data as such, because the time is almost here. Let's just see what comes out to be. So here we are. CPI is almost about to be posted. So today's CPI, it will decide the fate of the rates in the future. Okay, the rates that the Federal Reserve of United States of America will decide on 21st night. Okay, like this is the IST time, so this will be almost in the night, and then the federal funds rate will be decided. This particular data will be decided about when, how much this particular data is coming out, CPI data. Okay, so this is the particular situation. So if we are getting the data to be a bit positive, or a bit negative, then it will impact the overall fund, fund rate hike strategy of Federal Reserve, and accordingly it will impact dollar related products, different pairs, and dollar index as such. Okay, so that is why today's data is quite important. I would say some of the data, some of the expectation of the market has already been priced in. That means the dollar index has already come down very well. Now look at this. It has pumped up again. We were seeing a red candle today, and it has pumped up again. Look at how this is functioning. Okay, the market is expecting the data to be coming out, and everyone is pumping the dollar index. So the time is up, I suppose. We can see the interest rate, the data. Okay, yeah. So it is quite good, I would say, and that would justify the federal rate hike. Okay, the rate hike would be justified by such a data. The CPI has not come down, instead it has increased a little bit. Okay, the market expectation was in negative, but this has come out to be positive, and accordingly the dollar index has also pumped up. Look at the movement here. We started somewhere around 107, right? We were somewhere here. There was a red candle here, almost at this particular position. Within half an hour the movement has been this. So this is how the market functions. Okay, this is how data is priced in into the information in the market. So if you are a trader, and if you don't know about CPI data coming out, then how will you might be seeing all these red candles. You might have drawn certain retracement levels, and you would have shorted when I started speaking in the particular, like I started speaking at 5:30. So you might have shorted this position, but the price just pumped up again to 108. So the CPI has somehow dictated how the market is going to function in the coming week. Okay, The core CPI is also quite high, I would say, and that would justify a 75 basis hike, 75 basis point hike. So if you will come back down September 22, the expectation of the market is currently it is 2.5 percent. That is 2.5% is the federal funds rate, and the market is expecting 50 basis point hike. Okay, based on the NFP data, based on other projections as well. But I would say that currently 75 basis point hike is justified. Okay, because the CPI has not come down, and it won't come down because it takes time to phase out. Inflation always takes time to phase out. It is a phase in the economy. Okay, there are very less viewers. I suppose everyone is bored by such economic talk. Maybe, yeah, only 6 viewers tonight, like currently. So yeah, just a tip that the market will be expecting further movement in the dollar related products, just like we have seen here. What a fantastic movement. Let's go down, break it down, and look at this fantastic movement. This was pricing in. This is a 15-minute chart. This consolidation at this particular level. Then it came back down. It took a support, consolidated in the this particular range, and then look at this line. You can see. Which line is this? Okay, this is the path which I have drawn. Okay, nice. So it took a support at this position, and look at the movement. My God, this is a bomb blast movement, I would say. This is outstanding movement. Look at how many candles it is engulfed. It has pumped up and covered all these candles which have been formed. It is making a new high right now. The previous high, it is covering up the high of 12th of September. Okay, that is 11:30 in the night. So this is the movement that we have seen within our live streaming. So I would say you guys are quite lucky that we and I'm also quite lucky to see such a movement. Right, CPI was already downtown, and the people of United States would have gotten this information a bit earlier, and that is why we have seen a pump like this. We are talking about only 10 minutes ago. This candle is being formed, 6 o'clock candle, and just 4 minutes have happened, and look at the movement, and where it will go, we just don't know. Okay, so it has again pumped up, and this might be the next resistance, 109. Again there might be again a resistance at this point, and then again multiple resistances to cover. But what a movement, yeah, what a movement. Outstanding movement. Look at the open and look at the close, the high. 107.788. I started somewhere around here only. 107.766 was somewhere the starting point when we started. It was 5:30. It was 5 somewhere 5:30, I suppose. Yeah, this one. So somewhere we were around 107.766, and look at the movement, 108.811. This is quite outstanding. Let's look at other pairs. As I was looking at other pairs as also, I was quite shocked to see that there was a quite a grim movement in USD. Now this candle you are seeing, it is appearing to be very bullish, but previously it was completely red, and the body was below this trend line. It was completely red. This candle, today's candle, was completely red, and now the price has pumped up again. This is the beauty of the market. The market expects and the market functions in that manner. Okay, if you are comfortable looking at such data, we can do such live streaming uh, based on the data only. So this particular movement is very very good. I would say that this is one of the experiences that you might get on Market Insights. And such a movement, look at this particular movement in USD JPY. It was somewhere around 142, I would say 141, I would say. I was looking at this from the start of the day, but I knew somewhere around 6 o'clock there will be higher volatility. If you will go down to 15-minute time frame, there has been no movement, almost no movement today. There has been a very bearish movement. The price was around 141. I'm telling you this, 141, right? And look at the movement now, 143, 200 pips movement, 141 to 143. This is outstanding, and it is still pumping up. So such abnormal candle, na? This is an abnormal candle. These abnormal candles are only formed during a news event. Okay, that also you have to remember. Now, Dow usually said that market discounts for all information, and this is the information discounted by the market. Okay, the information has come, CPI, and the market has discounted this information. Absolutely beautiful. Now let's get back to our understanding of gaps. People are leaving here. Come on, this is a very interesting topic. I would say this is very lucky that we are about to witness such a moment in the market. This is outstanding. We would have taken multiple positions in US related products and stuff like that, and we would have got very good returns, I would say. Yes. So as we have discussed the CPI, and CPI has turned out to be outstanding, and a bomb has been particularly planted in dollar related stuff, and it has just exploded right now. We have just seen it live on Market Insights, and this is just the starting of technical analysis. This is just what is a warm up for the market, right? A 300 pip difference is a warm up for the market right now, because the market is so liquid and so volatile that everyone who knows certain things about the market is going to get into trading. Good thing about us here at Market Insights is that we provide you the particular tools and understanding of the market in order to form a very informed opinion regarding such events. This is the CPI data. Very nice. I was very enthused looking at such a data, and enthused looking at such outstanding movement in the market. Okay, I hope everyone here, whoever is looking at today's live stream, feels the same. Now let's just continue with our gap theory. Okay. So we were here that what were the common perceptions about the gaps? Okay. The common perception was that if the gap is formed in the market, then I will take the trade. This is normal trader. Okay. This is normal life of a person. That if the market has opened gap up, I will take the trade in the direction of the gap up. That is, I will buy. Okay, but that is obviously an error in my understanding of gaps. Gap up doesn't usually mean a bullish movement. Okay, or a gap down doesn't usually mean a bearish movement. Now remember my words, usually people are correct in their understanding that if the market has opened gap up, the market is obviously bullish, but your taking trade that at that moment might not be correct. That is what I'm telling you here. That is what my interpretation is here. If the market has opened gap up, obviously it is a bullish market, but usually don't see it, right? Don't see it, and if we take trade without any confirmation, then we might suffer great losses. This is what it is. Okay, this is the understanding of gaps. Now, how market interprets gaps? How does the market want to, show you, and in what way the market wants to tell you that such a gap has been formed? And this is what I believe. The market tells you certain things, huh? Just like we have experienced right now. Okay, that the market is telling us something. The market has told us so loudly that if the CPI is coming in this manner, then I will pump up the dollar related field. Okay, they're all dollar related pairs and stuff like that. This is a live movement, and this is an outstanding movement. If the CPI is good, I will pump up dollar, I will pump up the currency market. Now if you will see uh, DJ 30, you're going to that, look at this movement. Oh my god, the DJ was actually pumping up for quite some time, and every analyst was like, "Yes, there will be a bullish movement." But look at this movement. Obviously, there it was green before CPI data. It was somewhere around 620 somewhere. Okay, So now it has pumped down such a huge movement. Okay, let's pump down to 32,000 again. So this is the movement. And if the CPI is coming in this manner, then the market is telling you loudly and very clearly that I'm going to push the stock markets down, that I'm going to push the risky assets down. And this is the movement that we are seeing. This is just a 15 minute. Huh? This is within the time frame that we are looking at. Look at this movement. It was still in uptrend. It was still in uptrend till the point where the CPI data came out. Look at the timing, 6. Okay, look at the timing, 1800, and the price has fallen down drastically. Drastically, it has wiped off the gains of multiple days, I would say. Since the 9th of September, the price has been like this. And this is the market movement. This is how market want to tell you different things. Okay, in this manner, market wants to reach you and reach out to you and say something about how it is going to function in the near future. And accordingly, how does the market want to tell you about different gaps? So I would tell you that there is a very strong belief in technical analysis. This is a belief. Okay, this is not somewhere written. This is not a written rule. This is what I want to completely give a disclaimer about. So when I'm telling you that the market has gaps, okay, and the market abhors gaps. Abhors means market doesn't like gaps. Okay, market is, somewhere a continuity. It shows continuity in the price action, right? And we as traders also believe that this continuity must be maintained, isn't it? We believe that the continuity must be maintained in the market, in the price action, so that we can buy and sell in a continuous market. Okay, not in a interrupted market with gaps. Okay, I will show you with the gaps how the market looks like. So this is just a strong belief in technical analysis that market abhors gaps. Abhors means it doesn't like gaps. So if a gap is formed, what do you understand if the market doesn't like gap? That means the gap will be filled. Okay. Now what does this mean, sir? Gap will be filled. I'm just going to show you one thing. Look at this movement. Okay. A movement is there. Okay. The price is moving in this particular direction. And there is a gap being formed. Okay. There's a gap down, green candle, and this has been completely filled in within like 13, 14 candles. Okay, within 14 candles, and this is a smaller time frame. This is not a daily ka chart. Okay, this is a 15-minute ka chart, I suppose. The market has covered this particular gap within this time frame, right? So market doesn't like gaps. Market wants to cover the gap. Okay, this is what a strong belief in the technical analysis is. Okay, now this belief has also dictated the market's interpretation of gaps. Okay, how the market interprets gaps, right? So that is what I'm saying. The market is interpreting gaps as something that it doesn't like. Okay, market doesn't like gap, so multiple times you will see that there are retracements. Okay, there are retracements. This is a retracement to this particular level, na? There are unbelievable retracements. This is just a common retracement, I would say. This is very very common, very peculiar movement. But this is usually the case when it comes to gaps. The markets doesn't like gaps, and it goes on an extra point to cover that gap. That is the market's interpretation of gap. Okay. Now this idea that the market will cover the gaps is very, very important. Okay. When we understand technical analysis, especially the gap theory, this is a very, very strong belief in gap theory that gaps will be filled. Now when I'm saying will be filled, there is also catch in that. So you understand it properly. Like there is a literal meaning when I say that the gaps will be filled. There is a future tense related in that. So will be filled means it can be filled within 5 minutes, it can be filled within 20 minutes, or it can be filled tomorrow or day after tomorrow, after a week, after a month, or after 5 years or after 10 years, whatever time. We are not aware about the time. But obviously we are aware about the market's interpretation that the gaps will be filled, full stop. Understood? So we have seen, even in certain stock indexes, I have seen a very good retracement in the Indian index, okay, to the 15,000 level. There was a gap at the 15,000 level. So this is what gap theory usually, the market says about gap, and gaps, why they are important. Okay. Apart from that, I'm going to give you one very important hint, that gaps themselves are a part of a whole. Okay. Gaps themselves do not form a, successful strategy as such. But when understood within the context of Japanese candlestick patterns or classic chart patterns that we have covered in the previous sessions, so they can then become multiple confirmations for your trade. I will tell you how, what is the meaning of this line. Okay. So if a Japanese candlestick pattern is formed and there is a gap, and then that particular pattern is formed, then you are more sure that the price is going to reverse or the price is going to continue, right, in that particular trend. So that is the way gaps needs to be interpreted. Now we will just put in, I suppose multiple people have left because everybody is bored by the CPI wala lecture. So no worries. I'll just show you the market currently, and we'll see some really good gaps. Okay. So this is a stock. Don't worry about the stock. Every stock you can pull up. You can pull up any stock with good volatility, with good liquidity, and you can see gaps there. Okay. So for your understanding, I've used a gaps indicator from this particular indicator range. So you can put up gap, and this particular technical indicator would come up, gaps. You just open it up, and I've kept the setting at this particular 50, 30, 300. Okay. So this is how it points out different gaps in the market, different gaps in the market. Okay. Also when it is getting filled, so the gaps is also getting filled. Okay. Like this. Okay. Like this particular gap was formed here, and this particular gap was filled at this point after so many days. I would say this is 15-minute time frame na? Okay. Let's see if there are daily time frame gaps or not. Okay, this is the thing. I've got extra drawings in here, so I will just clean those up for you. Okay, this one is better. So look at this particular gap that has been formed in this particular stock. Okay, this was formed on 19th April. Okay, there was a big gap somewhere around of low is 333, and this is 234. That means $100 gap in this particular stock. This is a very huge gap considering the usual amount of the stock is 300. That is like 33% drop in this particular price range. And then we have seen that the price has never covered this gap. Okay, the market is unable to cover this gap. Okay, the price action has not able to breach this gap, and it is continuing. Okay, it is still continuing at this point because this is such a big gap. The market, now what people will say, now what was the common perception about a common trader, and what is the difference between a normal trader and a smart trader who follows market insights is, he will look at this gap down opening on 20th of April, and he will try to find out some confirmation. Okay, we'll try to find out whether to short or whether to hold the long position. If he's holding a long position, whether to cover it. Okay, if he's following market insights, then he would obviously keep a stop loss. If he's not keeping a stop loss, and if he's longing a particular or shorting a particular stock, then I don't suppose that that person is following market insights. No worries. So this is the gap down, and now where should I go? Okay, because this is a huge gap down. This might be the reason. Okay, I've already told you one example, right? When the stock goes dividend, ex dividend, right, the gap is formed. Or when the when the stock announces dividend, then the stock goes gap up. Now, this is another situation. This is another fundamental factor. It is called earnings and revenue. Okay, when the company announces its quarterly revenue, its quarterly earnings, its profits, etc., etc. So we see that reported was around. Look at the revenue part. Earnings was okay. Revenue has dropped down. The expected revenue was somewhere around this much, 7.929 billion, and the reported was around 7.868 billion. That means there was a negative of 7.77%, 61 million lesser. So how the market has punished this particular stock? $100 gap. This is what fundamental factor is, and this is the logical understanding of gap. Why the gap has formed only after this particular day? Why 333 to directly 230, 240? What is the reason behind it? This is the reason behind it. The revenue was not on point and the market punished the stock. Okay, this is the punishing. If it is not punishing, then I don't know what punishing is. This is $100 gap down. I suppose almost $100. Okay, then we can see other gaps as well. This again is a gap. Okay, this is also a down gap down, and market was somewhere around 507, and already it went down again $100 down, 400 somewhere around. Okay, so the market was trading in 500 range, it came down to 400 range. The gap was, the price action tried to cover the gap. Look at these two candles, bullish candles. It tried to cover this gap. That means the trading range has to happen in this particular range in order to cover that gap. Okay, just let me do this. If the price has gap down, opened, and it has went down somewhere around here, delete this. This is the gap down. Okay, this is the gap down opening. Price went down, and the price completely went up and covered this gap somewhere like this. Then I would say that this particular gap is covered. Okay, this gap is filled. That is what the terminology is. So if I'm saying a gap is filled, this is what I mean about by it. Now this is gap is not filled, although the indicator will show you that the gap is filled at this point, but that is not the correct interpretation of gap. Okay, if the price goes completely up and then down, no worries. It has to fill up this gap. So from this particular level, 459 to 504, there is an active gap. Okay, in this particular stock. If you go back, you will see hundreds and hundreds of different gaps. Okay, this again is a gap. Okay, this one again, which was not filled until this point. Until this point. Okay, the price movement took a lot of time. This is daily time frame. Gap was formed somewhere around 21st April, and it got completed around July. Okay, it took more than 3 months of work for the market to cover this small gap. This is how the gaps are filled, and sometimes the gaps are filled very quickly. Okay, I'll give you an example. We'll find that out as well. Look at this. Okay, this is a gap being formed. Okay, the price has reacted to this particular gaps. Okay, and this gap's lower band, this lower level, has acted as a resistance. Look at this particular candle. It looks almost like a hammer, right? This is a hammer candle, but because the prior trend is not proper, that is why we cannot take a bullish, trade here. So we need to wait and see what is the movement again. So the price has somewhat reacted in the next candles, and it has covered its candle, this particular gap, on this day, 19th March. So after 5 6 days, this gap was covered. Okay. Again, another example of such gap being filled, this particular gap. Okay. The gap is formed after 2 3 days, the gap is filled. So this is how market abhors gaps, and it wants to fill the gaps. Okay. It doesn't want it to, you know, that particular trading range to remain in that particular level. It wants to cover those gaps. Now we see that there are a lot of gaps in this particular range which has never been filled. and the range is around 70, 75, 77, 70, 50, right? So there are certain people who trade only on the basis of gaps. Okay, so if they will see this particular range, that the price of the stock is around 236. Okay, this is pre-market. This is the pre-market price. If the price is moving at 236, and if they will see that there is a gap open, this is a gap already open. This is an active gap which has never been filled. So they will say that the market, that the price of the stock should go to this level. Okay, it should. That is their belief. Okay, it might also, it might also go to these levels. I'm not denying it, because nothing is you know of certainty, complete certainty in the market. The stock might go in this particular range also. Okay, yeah. So we are almost up for our time. We have seen multiple gaps and their interpretation of the gaps, but a very important level, the types of gaps is missing. Okay, there are five types of gaps which we will try to cover in the next session. Okay, so until that time, I hope that everyone has learned something new today, and our viewers are very very patient with whatever I'm doing here, and there are also very curious viewers also. So I thank you for your time. I just want to show you one important update of where is the dollar index. Okay, what the movement can be in the dollar. Obviously, this was a retracement. Okay, the market was expecting that the inflation would come down, but no, it didn't, and the currency has come up back again because of this positive CPI data. Now, my current movement would be somewhere around at this particular position, and then it might consolidate in this particular level. And looking at the funds rate, it might go slightly up. Okay, slightly above this also, and it might maintain this level until anything wrong comes out, and anything of essence comes out which is wrong for the dollar. Okay, certain news of geopolitical tension or something like that comes out, then the price movement can be like this. But the consolidation is for sure, that will happen in this particular area. Consolidation is yet to happen, because the dollar index has pumped up so fast, and I don't like such movements, to be very honest. I don't like such steep uptrend, and that is why it consolidated at this position, because the market knew that this is a very steep uptrend. We don't like this uptrend, so let us consolidate at this position. And then it went down, and we saw that CPI data, how the price has reacted to the CPI data. It was outstanding in the live market itself. Okay, so if I would not have been here, I would have taken some trades, earned some money. So no worries about it. We'll just see USD JPY also, where it is now. Oh my god, such a movement here. 144. I would say it would close up here only. Let's just change the. I've drawn something. Yeah. So this is the position, and it is a completely parallel channel, uptrending parallel channel in this particular USD JPY. Here also certain gaps are formed. Look at this. This gap is formed here. There's a gap here, but it was quickly filled out. Okay, it was quickly filled. The gap was formed on 5th August, 6th August, and it was filled on 10th August, like in the next week. 3 days it took for the market to fill the gap. Now, here, what will happen in this particular thing is it will face a very strong resistance at this point. Okay, 146 somewhere around, right? Very strong resistance. Every day it is moving up. So, tomorrow 145, next date 146 somewhere around, so it will go up in this range. Okay, so this is the resistance upper band of the trend line of the uptrending channel. This is a very strong resistance point, and then it can kind of consolidate here like it did in the previous previous uptrends, like it consolidated here. It can consolidate here also. So this is today's session. Thank you very much for joining in, and I hope everybody learned something new. Thank you very much, and keep trading. Take care. Goodbye.